Coming up today, the stock market continues to climb on the back of an uptick in jobless claims. A look at buybacks, the latest in commodities, China rebounding, Vladimir Putin, Tesla, and the latest earnings results including from ABNB. And welcome back everybody to the end of this Thursday trading session. The S&P 500 breaking out to multi-week highs, now trading above 5,200, and this all-time resistance zone seems to be acting as a bit of a magnet, which I think we're highly likely potentially even test tomorrow, if not next week, as all the bullish conditions are present. A lot of bullish breadth, risk on, with volatility, bond yields, energy which often trades different to risk on assets, the dollar and inflation expectations all below their 20-day moving averages. And it's interesting because we heard from the Fed and the Treasury on the 1st of May, and ever since Jay came out and pretty much said no way he's going to hike, they're actually boosting liquidity by reducing their balance sheet rundown, along with Treasury using their excess funds to buy back bonds from the market. The both of them together successfully talked down bond yields and have once again got the animal spirits going because we've been nothing but up since then. Higher highs, higher lows. S&P added over 200 points since the Fed and the Treasury came out and told the market, we got you back, you're all good to go higher. And we can see that in the 10-year yield. From the 1st of May, just below 470, quickly lost 25 basis points in that time, which from that time as well has also sucked the volatility right out of this market. Got a huge VIX crush here. Also helping from that date was crude oil pulling back a bit as well, along with the dollar. So like I said back on the 1st of May, they likely lit a huge spark underneath markets, and that appears to be playing out. However, it was a really low volume day. You can see that on the SPY. Quite anemic at 43 million shares versus the normal 68 million. Same with the Qs, almost half the daily average. Now some may perceive that as a lack of participation in the rally. However, that's not always bearish. Typically, big volume days are often associated with selling, and we have seen time and time again when there's periods of low volume. For example, back here in late November, we had some really low volume days. That was actually a bullish signal for the market to keep drifting higher. And we've seen that in January, again in February, and a little bit there going into March as well. A few low volume days, the market's just basically drifting higher. Short-term breadth has come back in a big way. 73% of stocks above their 20-day average. And we've now got 56% of stocks above their 50-day average, and 3/4 of stocks still above their long-term 200-day moving average. However, what is a little strange in this market, apart from stocks that are missing on earnings, getting punished much more than usual. In fact, being sold off more the next day than any other time I've seen over the last decade. This current rally has actually been led by the defensive sector utilities. See the price action here, walk on the line, parabolic momentum, and my trend strength indicator's just gone positive after months of ranging, and this was on a really big volume day, which on a breakout to new highs can often be confirming and bode well for the medium term, even if we have a short-term consolidation or pullback. Also got consumer staples breaking out as well, along with aerospace and defense stocks. Pretty good rip there today in gold miners on volume, and the previous leading sectors of semiconductors still consolidating, looking pretty soft there, along with the other growth sector, consumer discretionary, and the momentum factor, hot stocks, still trading sideways a bit there. And so just looking at my sector analysis indicator, tracking 3-month trailing stock price performance, utilities are way out in front now, 19%. Coming into the year, it was technology, communications leading. Now technology's flat over the last 3 months, and it's utilities, energy, and materials having the most 3-month momentum here. And just a bit of a follow-up to my video yesterday, which I explained my VIX hedge. I know I got a bit technical there, and we're continuing to crush again today, down to 12.68. And so like I said, I'm going to leg into this, roll out my days to expiration, and hang around until we get that inevitable pop, which we normally do going into elections. And just speaking technically, typically when the VIX is low, under 15, it's very rare for the VIX to hit my lower buy-sell band. Just going back in history, you can see it very rarely gets down to the lower buy-sell band when the VIX is below 15. We can see it hit it there when it was at 22. But when the VIX is low, it's very rare that it hits the lower buy-sell band. And just going back in history, looking at previous election years, because that's really what I'm trading off here. Either an unknown surprise is going to hit us, or the election's going to eventually hit us. So looking back in 2020, for those of you who don't know, the US presidential election is always held on the first Tuesday after the first Monday in the month of November. It's been like that since 1845. And so here back in 2020, we got a pretty decent spike with the index given ample opportunities to hedge. We had weakness in May and June, spiked above 40, VIX crush going into August, spiked above 35, bit of a pullback before we spiked again into the election. Same deal in the election back in 2016. Actually had 2 decent spikes before the election, some crush, pullback, and then the run up into the election. 2012 was a bit more subdued. Still got a bit of a spike going into the election, getting into overbought territory, but didn't even make 20. But it did give opportunity to hedge down at the lows when it was oversold. And of course, the election year of 2008 is skewed by the global financial crisis. However, at one point in May, it was trading on a 16 handle, gave us a spike, pulled back to 19, and then exploded into the heat of the global financial crisis, actually getting above 95, also going into the election before it already started crushing. So here we are today, and for sure we could continue crushing and sit down here for who knows, a month or so. Like I said, I'm going to buy the dip, leg into my VIX hedge, roll out the dates, and hang around till we get that inevitable spike, which I would say is almost guaranteed to happen by late October. So I'm going to dig my heels in, and I'm not leaving this trade without a profit. And just going through some of the comments on my video yesterday, thanks to everybody who drops a comment, and a big shout out to all those who support independent financial journalism like this channel here, Click Capital. Appreciate all you guys that hit that like button. And so just to answer some of your questions on the video, as I thought, if some of you are asking these questions, there's probably others that are thinking the same thing. And so one thing I was asked is, what about going long the leveraged volatility ETFs like VIXI and UVIXI? And so they are popular, heavily traded leverage ETFs. However, how VIXI and UVIXI work is they always hold the front month and second month VIX futures. And the thing to know with that is that the VIX term structure, that is looking at all the dates going out, is pretty much always in contango. You can see that here in the cash market. The VIX 9-day 11.9, the VIX 30-day, the one we always look at, 12.6, 3-month 14.7, 6-month 16.8. The futures have that upward rising term structure as well, with the premium. And I guess the easiest way to explain that is if there wasn't a premium. For example, we're looking at the VIX November contract, so that's 17.4. Well, the cash VIX is at 12.6. If there wasn't a premium and we could just buy the November VIX contract for 12.6, it's pretty much guaranteed to make a profit. As at some point over the next 6 months, we will get a spike and it's easily sold for a profit. However, there's no free lunch in the market. You always have to take a risk to get a reward. And that's why there's an inbuilt premium most of the time in VIX futures the further you go out. And then that'll converge with the cash index come settlement. And so because of that, these ETFs always have to roll over. They'll sell the front month, buy the second month for a higher price, roll over, and they'll lose that premium. That's why over the long term, just going out to a monthly chart, I actually have to switch over to the logarithmic. It's just full of decay. It's down more than 99% in the long term. So this thing's constantly crushing, and any pops in it, most of the time fall over more than a bad meme stock. So this instrument, there's actually more money to be made by shorting the pops than going long on this. To nail a long volatility trade using this instrument, you really have to get your timing perfect, and it's only good for a couple of days. Otherwise, the crush is going to get you. However, I don't recommend at all shorting these, as if we do get those surprise events, they can rip up worse than a meme stock as well. So to answer the question, going long these leverage volatility ETFs is not the same as my VIX bullish call spread. Because like I said yesterday, buying the 12 strike, selling the 19 strike, it's actually theta positive, meaning the trade earns money with the passage of time, whereas those leveraged volatility ETFs are full of decay. Someone also asked me, can I summarize how Treasury auctions work, since they're pretty important this week? And so I'll quickly just touch on that, as I'm sure others may be wondering how Treasury auctions work. So we just had one today, a 30-year bond auction, which went better than expected. Previously, Treasury had to offer 4.67%. Today they got away with 4.63%. So to make it as quick and as simple as possible, basically the US Treasury comes out with a quarterly refunding announcement in the second month of every quarter, February, May, August, November. And they'll let the market know what type of treasuries and how much they're going to sell in order to fund the Treasury General Account. That's the account the government actually spends money out of. So they plan what the government needs to spend. And because they run at a deficit, that is their tax revenue and receipts, don't cover their expenditures, they make up for that shortfall by selling treasuries. So treasuries that expire in less than a year, they're called treasury bills or T-bills. Treasuries that expire in between 1 and 10 years, they're called treasury notes or T-notes. And then treasuries that expire in 10 years or longer, they're called bonds, treasury bonds. So T-bills are short-term debt, notes are medium-term, and bonds are long-term. And so they run these auctions all the time, and Americans can actually directly participate in them through the government website, treasurydirect.gov. You can directly loan the US government your money, and they'll agree to pay you back what's known as a coupon, which is the yield on the bond. And that's the primary market, the auction. Then the bonds can trade on a secondary market, and their value will move up and down opposite to yields. So here we're looking at the US government bond 2-year yield, 482. And if you were to buy bonds when they're at 5% yield and the yield moves down, and then because new bonds are available at 482, your old bonds that you bought at 5% are worth more. That's why as yields go down, bond prices go up. Because if you bought bonds at 4.2% and the yield shot up to 5, then investors can easily buy new bonds for 5%. So your old bonds at 4.2% coupon are now worth less. I also had someone ask me, for some commentary on the Japanese yen. And so you've probably seen it in the news recently, the sliding value of the Japanese yen. Here's the dollar yen. You can see the dollar appreciating against the yen. Went into a bit of a blow-off top around 160 before it appears the Bank of Japan stepped in, started buying their own currency to try and bring it down. And so just going out to a monthly chart and to explain why the dollar's appreciated so much against the yen. And this is a bit of a long-standing problem with Japan that's just been exacerbated the last couple of years. In that time, inflation's shot up. The Federal Reserve has lifted interest rates, which has lifted bond yields. And so basically, big, large institutional investors can earn a higher yield in USD assets with short-term yields around 5%. Japan's an outlier in the world of global developed economies. Their overnight rate's still 0.1%, so that creates a huge carry trade. Borrow yen, buy US dollar assets and bonds, and earn that big interest rate differential. And of course, it's been piled on by speculators, adding further upside to that. And there's a look at all countries around the world ranked by their government debt to GDP as a percentage. And we can see Japan's only second to Lebanon, 264%. Got Sudan, Venezuela, Singapore, Eritrea, Greece, Italy, and the United States, 129%. The fears out there in global markets is the United States over the next 20 years is going to get up to the top of the list, above 200% as well, as most countries are well below that. In fact, average is somewhere around 50%. Some countries, going all the way down to the list, have very low debt relative to their GDP. And so because of all that debt, and we can see that in this map here, Japan really sticking out above 250% in the dark blue, and America getting up there in the blue as well. The darker the color, the more debt to GDP. And so Japan basically can't afford high rates. They do massive amounts of quantitative easing, printing money, which has had the effect of devaluing their currency as they artificially keep interest rates rock bottom lows, also counteract the huge deflationary pressures they've had over the last 30 years, along with declining demographics. And like I said, that's been exacerbated the last couple of years as they've increased their debt from pre-COVID 220% to right now around 250%. So basically, all that adds up to a huge carry trade pile on the Japanese yen, which is good for their exporters because their currency becomes cheaper for foreigners to buy their goods. However, that's bad for a lot of consumers because then the price of their imports goes up, which they have to import a lot of food, gas and oil as they don't produce a lot themselves. That's why the Bank of Japan tried to step in and save it. And as we can see in this chart here, bullish sentiment on the yen as a percent of open interest on Japanese yen futures down near record lows, along with net speculative positions, meaning the market is really short on the yen. Have a look at the Purchasing Parity Power Index, popular way to value currencies, shows that the yen could be significantly undervalued against the dollar. And because we're all talking about it now in the media, we're probably more likely closer to a top than a bottom, I'd say, especially if the Fed goes ahead and pulls back those yields. That's going to help the yen as well. Okay, so I hope you guys found some value in that. And like I said, if you'd like me to cover anything else, just drop a comment. Let me know what you're interested in, and thanks to everybody who shares their thoughts on this channel. I really enjoy interacting with you all. And just moving on with a daily review. Actually got a little bit of a surprise jump in jobless claims today. Highest level in 9 months. 231,000 new people filing for jobless claims the previous week, well above expectations of 214,000. Also coming at a time we're seeing a spike in bankruptcies from corporate companies as well, as it looks like these high rates are still biting some, which they typically do. Looking back in history, even though we just heard from the San Francisco Fed president today saying she sees a really healthy labor market, which is true. Unemployment's still under 4%, and that jobless claims is just 1 week. We get a look every week, so it could be just a bit of short-term noise. However, if that trend continues next week and going on, the moving average starts pointing higher, could be a bit of a canary in the coal mine. And that latest look at the jobs market may have actually helped yields pull back again a bit here today, just as Jay Powell and his best buddy Janet Yellen want them to, as he seems more concerned with bond yields coming down than inflation, judging by their action. And just reading that today reminded me of this famous tweet from 2022. They printed 8 trillion, gave you 1,400, that was stimulus checks, sent the rest to their friends, and left you with inflation. And that was quite a lot of good foresight coming back in April 2022, this random person on Twitter published. So most people are still struggling with that inflation, but the stock market is not. So a very good chance we hit all-time highs next week and breaking through the 5,300 level for the first time ever. In addition to lower bond yields, also a big structural force in the stock market is corporate buybacks. Companies buying back their own shares with excess cash, just like we heard from Apple last week. Conveniently come out and announced that a couple of days before Warren Buffett announced he was trimming big time. And so it's a controversial measure. It's not really innovative, doesn't create any new jobs. It pretty much just boosts the stock price higher. And we can see that, for example, with Apple, who spent a whopping $645 billion on buybacks in the past decade. And even though their revenue over the past decade is only up a little bit more than double. And like I said, has been actually declining these last couple of years since they peaked out in 2022. In that same period of time, over the last 10 years, stock's up 654%. Revenue's up 110%. The stock price is up 654%. And that's because they've purchased about $650 billion in stock as well. It just squeezes the stock price higher. Maybe if they had invested that into AI or some other new innovative technology, would have created a whole lot of new jobs, better for the actual economy. However, we live in a highly financialized world that is pretty much structured to mostly benefit the top 1%. It's a shareholder-driven society, and so the system achieves perfectly what it's designed to do. Because if they had invested that $650 billion, the stock price might not be as higher, even though revenues could be higher, there could be more jobs, better technology, they wouldn't be lagging in AI. Instead, they just come out with one or two little tiny updates to the iPhone and get everyone paying $1,500 every couple of years just to buy the latest iPhone. They haven't really done much innovation, and what they should be is leading the AI boom. But just like Jay Powell, the pain's left in the real economy, all the benefits goes to the top 1%, who pretty much own over half the stock market. And that's set to increase next year. Annual stock repurchases by S&P 500 companies set to surpass $1 trillion. For the first time ever. Like I said, that's a huge tailwind and backstop for the stock market. In addition to the Fed and Treasury, we'd need a real surprise for this market to crash or even so much have a correction as 10-15%. That's why the government is coming after them, proposing a 1% stock buyback tax. And I'm not normally one to agree with more taxation. I'm normally one for minimal government involvement. However, on this particular issue, I agree, because where does it stop? Should companies just put all their excess profit back into buying their own stock? And what's the end goal? There's no stock left on the register. The stock price is trading at $1 million per share, and the top 1% own 99% of all wealth. Is that the path we want to go on? And don't get me wrong, I'm not arguing for socialism. I do believe in capitalism. I'm just against extreme capitalism, which is the path we're currently on. And so all that excess liquidity found its way into the stock market, could be finding its way into the commodity market now. We've got agricultural commodities like wheat and corn that have been in a downtrend and sleepy for a while, starting to wake up, with of course climate change and global clean energy policies exacerbating that as well. On top of that, actual demand coming out of one of the world's biggest consumers of commodities, China, is bouncing back. We saw that today with their imports, the amount of goods they're bringing into the country, jumping by 8.4% last month, exceeding expectations, showing that they're buying again, and that's likely to keep a tailwind in commodities as well. And in addition to crude oil, what also correlates with inflation is the price to move goods around the world. You can see that in the Shanghai Freight Cost Index, ripped up after COVID, more so to do with supply side constraints, a lot of factories and the like shutting down, then exacerbated by inflation, fell over in 2022 along with markets. We've bumped up this last half year and looks like we're turning up higher again. Once again, another tailwind for inflation here that you won't hear Jay Powell talk about. Oil may have also found its footing here after it was recently sliding. However, counteracting that is the US market is flush with supply and producing it at record levels to help counteract the demand and anything happening in the Middle East and with Russia. However, the Middle East and Russia still hold sway over half of the world's supply. They are the biggest variable swing factor in the price. And Israel does not want to back down. They have a strong will to finish the job in the Gaza Strip. They're using it as an opportunity to reshape the map for generations to come, and they're expanding their war and look to overtake Hamas's last stronghold of Rafah, and this is much against the Biden administration's wishes, who's trying to get them to cool down. And now we've just seen the Biden administration threaten to freeze some weapons deliveries to Israel, and a pretty big move and signal, potentially setting up a bit of a showdown with Israeli Prime Minister Benjamin Netanyahu, who, like I said, with his team, seemed determined to finish the job in the Gaza Strip. This comes at a time when we've got the barking dog, little man Vladimir Putin, constantly throwing out nuclear threats against the West, saying in their Victory Day parade his strategic forces are ready to retaliate and he will not accept any NATO troops on his border. And it's almost like NATO and the US-led Western Alliance military leaders are almost trying to egg on Putin to do something as an excuse to shut them down, as I'd say they already have a plan in place. As soon as they start seeing nuclear weapons getting moved around in Russia, that could be the green light just to go ahead and shut them down. So wouldn't that be a surprise if we woke up one morning and the West has conducted a big operation to disarm Russian nuclear capabilities? And that could happen this year, maybe. Moving on, and the woes at Tesla continue, with their product launch chief quitting, taking a swipe at Elon on his way out. They've been cutting staff have been leaving, after we just heard the government coming after them again on potential securities and wire fraud, overselling their self-driving technology. And there's a look at the stock price, which I'd say is very hard to trade now. So much headline risk, back and forth on the stock. Just hard to see it ripping up above 200 with everything that's going on. At the same time, it seems to be well supported. And we're making our way through the back end of Q1 earnings season. Just heard from Airbnb. Market knocked them over a little bit as sales guidance disappoints. Profit for the first quarter came in $264 million, up from $117 a year earlier. Revenue rising 18%. And there's that trend of the market having no tolerance for anything close to a miss, selling off the stock almost 7% today. And one of the oldest brokerages in America is completing its final steps of being swallowed up by Charles Schwab. TD Ameritrade, been around since the early 70s. They were actually the first company to offer electronic trading platform back in the early mid-1990s. I traded with them for a few years. Even though their platform wasn't the greatest, their customer service and account managers did a good job at looking after you, and they would negotiate on commissions. And so this weekend, the remaining 1.8 million accounts with them will flip off the TD Ameritrade branding and switch it over to Charles Schwab. And there's a look at the liquidity index, also known as Bitcoin, hovering around $63,000 a coin. There's gold defending its 50-day, along with silver doing a bit better, popping up there. Natty gas starting to rip now. China bouncing back up. Cannabis may have found its footing in the support zone I identified. We'll see whether it can take out the 50-day tomorrow. Bit of a pullback in semis today. You can see that in NVDA. And there's Meta, pretty much right back at its 50-day. And a pretty good day for AMARK, up 7%. Reclaimed all of its lost earnings gap and some. Really strong price action. Investors buying this dip, even though they missed on earnings. Revenue's still growing. And so that's a good sign for us shareholders in that. And the big banks continuing to like these lower bond yields. Okay, so there we have it. Marching higher. Back to all-time highs. Barring any surprises, we should be breaking out next week. Potentially looking towards 5,300. Options market certainly expects that. And with yields down, crude down, that's all really supportive. But like I said, it's been led by the defensive sector of utilities and what could be a bit of a stagflation play, which is typically the best performing sector in the economic scenario of stagflation, in addition to the dividend yields becoming more appealing versus lower bond yields. Thanks very much for tuning in to the Daily Market Review, and you're welcome to leave your comment under this video. And I'll see all you guys again for the last trading day of the week tomorrow. Cheers.